So I thank you all again for attending our webinar, Are You Ready for Commodity Market Changes? Our two presenters for the day are Lee Henson from Thomson Reuters and Preeti from Eko Software Solutions. We begin with Lee Henson, the Global Head of Commodities, Customer and Supply Chain Risk in the Financial and Risk Division of Thomson Reuters. The division delivers news, prices, fundamentals, research and forecasts, collaboration, transactions, and risk services to support the trading and operational activities of corporate and financial customers across global markets. Lee has been with Thomson Reuters since March of 1988. Along the way, he has served as Director of Institutional Equities, responsible for the development of equities transaction services globally, and was a Director of Reuters Transaction Services Limited. As the Equities Manager of Nordic, he was responsible for marketing corporate products and managing the development group for domestic equities quote service. Lee, thank you for being with us today. I'm going to switch over to your first slide here. Okay, Lee, I'll turn it over to you.
Thank you very much, Rana, and good morning or good afternoon to all of you on the call. I think this is a very interesting sector and point in time in the sector of the commodities market. And I want to talk a little bit about the markets and the cycles that commodities typically go through. So if we can move to the next slide, please, Rana.
Absolutely.
So commodity prices follow a typical cyclical pattern. You can really see this most visibly in energy and metals market. The pattern results really from the time lag between the supply side needing to react to changes in demand and vice versa. So typically, as a result of high prices, companies invest in expansions and development of additional capacity to capitalize on those prices, whereupon the supply increases to a point where the prices begin to retreat as the supply outpaces the demand. Supply continues to rise typically and prices to fall below the marginal cost of production. And as a result of this supply glut that we get to at this point, the capacity closures start to occur in the supply side, prices begin to stabilize and rise again. So over the last 50 years or so, we can clearly see this because the commodities markets have experienced three of these typical price cycles. And we can illustrate this by looking at a broad run index. I happen to like this chart, which was put together by Tiberius Research, and it's based on an excess return index for the commodities over the period. So that's the returns over and above the returns that you get on cash. And we can quite clearly see the periods of broad undersupply, which is the phase one periods within each cycle, and the broad periods of oversupply, which are phase four. The last cycle is a little different. Phase one of the last cycle, which was dubbed the commodities super cycle by many in the press, it lasted almost 10 years from 1999 to the summer of 2008, and that was mainly driven by the rapid growth of the Chinese economy, creating abnormal demand and catapulting nominal commodities prices to the record limits. And we can look at that last cycle in a bit more detail. If you can move to the next slide, please, Rana. This chart shows that cycle using the Thomson Reuters Core Commodity CRB Total Return Index, which is a basket of 19 commodities, roughly 40% energy, 40% agriculture, and the balance in industrial and precious metals. The big question really in terms of the cycle is whether we have reached the point where capacity has been taken away sufficiently to embark on phase one of the next big cycle. We'll zoom in and look at the last few years, but before we do that, I think it's interesting to look at this chart from a technical perspective as well as a fundamental perspective. So if you could move to the next slide, please, Rana. If there's any Elliott wave practitioners out there, we can label the chart as a classic 5-wave impulse upward move, as you can see here, 1, 2, the impulse wave 3, 4 and 5, followed by a 3-wave correction. And as I put on the chart, the question mark really is, have we got to C yet? So let's look at the next chart, next slide, please, Rana. If we look at these most recent couple of years, we can see the continued drop-off of prices in 2015, followed by a recovery in 2016. The X that I've marked on the chart, it marks the spot where we conducted our market survey of analysis tools and investment plans on behalf of many of our customers, which we'll examine in a little bit more detail later on. But I just wanted to bring this picture up to date since then with the price development into 2017, which we can see has been broadly negative from the end of 2016. So in the next few slides, we'll look at these 3 years in a bit more granular detail. Yeah, can I have the next slide, please, Rana? Okay, so for 2015, what we can see here is a relative performance of different commodity categories using a very simple unweighted basket for each of the complex. So for energy, you're really looking at crude, WTI Brent, and natural gas in the form of Henry Hub. For ags, you're looking at the grains complex, corn, soybeans, wheat. For base metals, typically aluminium, copper, nickel, zinc, lead, and tin. And then for precious metals, you're looking at the 4 big ones: gold, silver, platinum, and palladium. So we can see that in 2015, the price drops were driven predominantly by energy and metals, and clearly a stronger US dollar, as you can see from the index at the top, also contributed to those movements. The next slide, please. In 2016, we have a real difference. We have a lot of prices recovering pretty much across the board. Again, predominantly driven by energy and metals. And the interesting thing here is that even as the US dollar continued to strengthen, so those prices rises were seen in those 2 complexes. I think it's also worth pointing out here that across 2016, agriculture is lagging by some margin. And then to complete the picture, let's look at the year to date for 2017 on the next slide, please. And again, we can see that commodity prices have dipped, even with the US dollar weakening somewhat. And only precious metals are really bucking that trend from the commodities complex. So let's have a look at some of the fundamental drivers. Can you go to the next slide, please, Rana? Let's start with demand. Well, the big issue around demand is really China. The Chinese economy is really transitioning from an export or investment-based economy based on industrials and manufacturing to much more of an economy which is built around domestic consumption by consumer and services. Given that China imports pretty much 50% of the world's commodities, any slowdown in that economy naturally has a big impact on demand. In the early 2000s, Chinese growth was estimated in the high teens. More recently, however, according to the IMF, that's down to somewhere around 7%, and it's been steadily falling. 2014 was 7.3%, 2015 6.9%, 2016 6.7%, projected to fall to 6.6% this year, and again to 6.2% next year. And some of that growth, and to a certain extent the value of the currency, the yuan, has still been propped up by significant increases in debt within China, which now stands at around 277% of GDP. That Chinese currency devaluation from 6 yuan to the dollar around the end of 2013 to 7 the end of 2016 is interesting. I mean, from a devaluation perspective, it makes Chinese exports more competitive, but it also makes material imports more expensive. And there's no doubt that this picture would have been a lot worse without that government intervention. So the one key question around China really is how long can that intervention continue? Well, there was some Chinese fiscal stimulation withdrawal, which really sort of contributed to the 2015 price slump, although we saw some reprieve in 2016, and maybe that's one of the reasons why we saw markets recovering in 2016. But it's also worth looking at fiscal stimuluses from other parts of the world, most recently Japan, and of course with the promises that President Trump's making for infrastructure spending in the US. And then finally, it's worth mentioning that towards the end of 2016, there was a lot of volatility in commodities futures prices, which were driven up and down quite significantly by Chinese speculation after the 2015 equity bubble burst in that region, and a lot of hot money rotated out of equities into commodities. So really, those are the major drivers, I think, in terms of demand across the board for commodities. But what we can look at more granularly is supply. And as I stated previously, it's all around the fact that supply tends to have this time lag in responding in changes to demand. So if we were to look at the oil markets, for example, as many of you know, I'm sure, OPEC and non-OPEC members agreed a 1.8 million barrel per day output cut in response to falling prices, and have recently extended it to March 2018. But what I think has taken the whole market by surprise is the strength and speed at which the US shale output has returned. It's up over half a million barrels per day since September 2016, projected to grow another 440,000 barrels in 2017, another 650,000 barrels per day in 2018. And the number of rigs being employed to drill for US shale stood at around 425 in September 2016. That's come up to 722 in recent years. Now, typically there's a 6-month lag between new wells and production, so this explains why we will see that production carrying on growing throughout 2018. Recent price falls will mean that rigs should peak in June, July this year. Typically, there's a 4-month lag to rig numbers to prices. So as prices fall, around 4 months later, you'll see the rigs start to turn as well. Other non-OPEC countries like Brazil and Norway are also seeing their output rising. So in summary, we need a period of flat or lower prices to really curb that US shale production, which has started to show a lot of agility in reacting to demand. Base metals, there's a lot of differences across the complex, but in copper and aluminium, there's still a lot of capacity there, and I think the market needs supply closures in order to turn. Copper suffered a lot of high disruptions over the past year, so the 2017 surplus we were expecting will be a lot smaller, but it's anticipated to rise again next year as the levels of disruptions tail off and restarts at lower cost and more efficient operations cut in. Aluminium, large stock situation, but it's being slowly eaten away by small deficits. Zinc, the market already turned a couple of years ago after significant mine closures, and the fundamentals are just getting tighter. And nickel is one of those interesting ones where you've got a political environment and pressure in places like Indonesia and Philippines, which are now starting to recede, and we can expect export growth to resume. In the precious metals market, the supply capacity is pretty much flat to slightly down. Many producers are paying dividends rather than reinvesting, and so together with the emergence of some low-cost producers, for example, we expect to see silver prices supply to drop off more than it has, but LatAm producers such as Peru have ramped up their production. And in some major producing regions like South Africa for platinum and palladium, there's a lot of political pressure to carry on producing even when prices are low. So in the precious market, as I said, the supply capacity is flat to slightly down, but I think it'll take some time to work out. On agriculture, we talked about that earlier at the grains. There's been record harvests worldwide in the major supply countries, including US, Brazil and Argentina. World grain ending stocks are steadily climbing to highs, currently over 600 million metric tons in storage. And the debates really are over whether or not bad weather could change the picture in the short term. For example, the US had a cold, wet spring, is now recovering into more favorable conditions. El Nino is quite interesting. It may reappear. It would be unusual given that the last one was in early 2016. but we are seeing areas warming already. The impact of El Nino really depends on the timing. If we get warming earlier rather than later, then that actually could be favourable to the US at the expense of places like Australia and Southern Hemisphere. LNG is an interesting market in terms of supply. There's a lot of extra capacity coming on. We're estimating 34 billion cubic meters per year of supply added in 2017, mainly from Australia, Gorgon and US in the Sabine Pass. And although China and India are likely to soak up a lot of that, they won't suck it all up. So what we see happening in the market is buyers trying to change long-term contracts for the right to participate more in the spot market. So there's a lot of interesting fundamentals going on. Big ones being softening demand from China, and in the supply markets, a lot of overhanging stocks and a lot of production going on when perhaps it should be starting to rein in. So if we go back to when the survey was constructed in October 2016, if we could move on to the next slide, please, Rana. We conducted a global survey of some almost 750 commodities professionals to try and understand, given the market conditions, what tools, data and systems they are using to drive insight, make trading decisions and keep abreast of market moving events. So given the positive trends in the market at the time, we found many professionals were poised to make big investments in data and tools. And in particular, we found executives seeking more sophisticated analytics capability, driven by feeds and enterprise data management systems. There's almost 750 professionals across 40% in Europe, 33% in the Americas, 27% Asia Pacific, across different company types, mostly corporates. That includes producers, consumers and trading houses, but also financials in terms of hedge funds and prop traders. And then across the industries, broad set of industries, energy, metals, ags, and other in terms of shipping and logistics. So I'm going to lead you through some of the key findings of the survey. Go to the next slide, please, Rana. So these tools are the primary sources of insight that our respondents came up with. Pricing topped the list. This is consistent with previous year's surveys. We do this on an annual basis. We see a lot of consistency year after year. Analytical tools are also important because they're used to really enhance the value of the information by manipulating and interpreting a variety of different scenarios with market factors. Front office teams in particular, and especially sales and trading executives, value this content and related tools. Over 50% of sales and trading users describe these items as very important or business critical. And we also see, again consistent with other years, the continued popularity of fundamental information and analysis and commentary, which highlights the importance of interpreting the raw numbers to drive broader insight. Finding this signal in the noise, if you will, was rated as a true value add. Look at the next slide, please, Rana. So let's look at platforms in investments. Well, almost 70% of our survey recipients currently rely very heavily on desktop platforms as a way of consuming data and applying analysis, but 56% also consume information via feeds, and 37% are already using enterprise data management platforms. And the good news is that investment in all three of these areas is projected to grow in 2017, with the emphasis anticipated more towards EDM platforms and feeds than desktop. Get the next slide, please, Rana. We asked quite a lot of detailed questions about why and what were driving these investment budget decisions. And many recipients, over half of them, cited more users and more usage as key drivers, which if you think of the backdrop of a improving market, it's easy to see why some of them would say that, and it really reinforces that bullish view at the time. Other key drivers were more functionality and more content, which again emphasizes the continued thirst for the latest information and tools to help professionals perform at the highest level. The next slide, please, Rana. So enterprise data management is really an interesting space. It's become an area of increased focus as organizations seek to manage the complexity in data in terms of not just complexity but also volume. The rise in popularity in these systems looks set to continue across all customer segments, given the budget expectations that they've expressed over the next 12 months. And it's worth pointing out that currently this trend is being led by larger companies. We segmented the companies by size, and 52% of the larger companies report EDM usage currently, rather than the smaller firms where only 24% report EDM usage. That's the next slide, please, Rana. If we look at the reasons cited why people use data management systems in more detail, the big ones are reducing the total cost of ownership and centralizing data. They're the main reasons why firms invest in EDM platforms. But they also cited reducing operational risk and creating an analytics platform, really highlighting the need to drive clarity from complexity and volume of data, both internal and external from the market, in order to try and pinpoint unique, maybe, and valuable insights into that data set. Have the next slide, please, Rana. So to conclude on the survey, the sheer volume of data available to analysts and traders is growing exponentially and becoming more and more complex in its composition. So it's essential that this information is quickly and efficiently analysed, so that informed decisions can be made often in real time, and unfolding opportunities can be maximised. On balance, I would say from a market perspective, the next commodity cycle appears to be on us already. As the sector continues to rally, commodities professionals therefore should ensure they have access to a comprehensive selection of key information sources, and to marry that with the best technology available to analyse those data sources to enable them to benefit fully from this expected market buoyancy. So thank you very much for listening. I'm going to hand you back to Rana now.
Thank you so much, Lee. I cannot even keep up with the amount of information you guys have. I can't wait to see that full report next week. I would now like to introduce our second speaker of the day. Preeti Ramesh is the AVP of Product Marketing for Eko Analytics. Bear with me, I'm just trying to swap the slide here. With more than 16 years of experience in the domains of CTRM, banking, and finance, Preeti has an excellent understanding of today's markets. Her responsibilities at Eko span product management, product marketing, implementation, and pre-sales, giving her the unique insight into the challenges facing commodity market participants today. Thank you, Preeti, for joining us today. I'll turn it over to you. Preeti, are you with us?
Yeah.
There we go.
I'm here. Can everyone see the slides? I can only see the poll question.
Okay, let me give you 2 seconds to close that off.
Thank you.
You're welcome.
Thanks, Rana. Hello, everyone. Before we begin, I'd just like to take a few minutes to introduce Eko, who we are and what we do. Next slide, please, Rana. Eko was founded 13 years back and has grown to a 315-member strong team across 9 global offices. We are profitable, growing, and backed by premier investors like Silver Lake Partners, GP Group, and Nexus Venture Partners. Next slide, please. We have over 50 plus tier 1 customers across segments, across commodities, across geographies. They're all highly referenceable, and in fact, some of the mid-sized customers can even boast of a record implementation of 6 to 8 weeks, some very recent experiences that we've had. Next slide, please. So Eka's solution suite consists of two broad categories of product lines. One is the transaction management, where we have the best-in-class ETRM and CTRM systems working across energy, ags, metals. We also have our analytics offering that connects to both Eka and non-Eka systems, and that's our focus for today. That's our topic for today, commodities and analytics. Again, working across all segments and pretty much commodity agnostic. Next slide, please. So what has the market been telling us? What has our research been telling us? So for the last 2 years, we've been researching the commodities market extensively on the topic of analysis and what's really bothering them. So Eka surveyed 42 executives at commodity companies across segments, and 48% are telling us that integrating data from multiple sources is still a challenge for them. 47% are saying to solve those challenges, either their solutions that they have today are not going to be able to meet that kind of scalability and the functionality that is required. And even if they did, it is going to cost them a huge amount of time and money. 66% surprisingly are still using spreadsheets in one form or the other for their analytical needs, and they lacked a BI analytics solution in place for their entire organization. More research has shown that, with over 100 plus commodity companies that we've been interacting for the last 2 years, that over 95% at least have started thinking about it and want to implement an analytics strategy in the next 18 months or so. And over 30% have an EDM initiative in one form or the other, maybe stage 1, stage 2, stage 3, depending on the size of the company, similar to what Lee mentioned. So, despite having, multiple ETRM, CTRM systems, ERP systems, maybe even a BI tool or a data warehousing company in place, why do most companies rely on spreadsheets for all or so much of their analytics? And is there truly a better alternative? Next slide, please. More market analysis, and this is a sample value chain. So again, when we dug deeper, value chains are becoming more and more interconnected. Right? There's global sourcing, global customers, global pricing, global competitors. Many of the same factors are affecting the entire value chain, so be it prices, weather, or geopolitical situation. For example, let's take weather. It could be affecting on one part of the value chain. It could be affecting the demand and supply. On another part of the value chain, mid-segment, it could be affecting the throughput of your machines because of more rain, more moisture. Or it could be affecting the transportation costs in another part of your value chain because the weather, it's too rainy, or your transportation is getting affected and the costs have soared up. So throughout the value chain, people are talking to us different problems in different parts of the value chain. So if you take this example, it is just for an energy value chain, and you can say similar things in metal, similar things in agriculture. But if I were to take this example in front, so in the upstream side, people could be talking to us about vessel scheduling and vessel management. On the midstream side, people could be talking to us about refinery margin optimization. On the trading side, people are talking to us about how can they integrate an external VAR model, and put together equities and the commodity book and see a global VAR on their whole organization. And on the downstream side, somebody could be talking to us about, logistics management and transportation optimization. So what we've seen in the market is enterprises truly are looking for actionable insights throughout their value chain with all the data that they have in place together. Next slide, please. Our answer, Eka Analytics for high-value business issues, and how we solve that problem is with bite-sized apps. Each app solves a particular business problem, and you can solve one problem and then scale to the next one by taking another app. It's not a big bang approach. We're both cloud and tablet enabled, designed for both. Highly secure. Security is becoming a big topic in itself, with data being, highly secure on cloud or on premise. And then, of course, self-service analysis design paradigm, which enables business and analysts to move at a much faster speed than having to rely solely on vendors and the IT team. Next slide, please. So Eka Analytics, 5 times faster and brings 5 times more value to configure an out-of-the-box solution for the commodities and segments, works across segments. So it's a readily available solution. Our 4 design paradigms, which I will elaborate in the next couple of slides, as you can see, first one is our connect layer, extract data from any source, internal or external. Second is our enrich layer, which is for enhancing the raw data that we bring in. Third is our analyze layer, which is for running simple to medium to complex algorithms. And fourth is our decide layer, which helps to visualize and get value out of that in analysis that we've put together. Next slide, please. So starting with the step 1, which is connect. So connects. So the Eka Analytics connects to multiple systems, can connect to multiple commodities, multiple regions. We've pre-built adapters. For example, Reuters is one of our standard adapters that we have built, and we have many more. Data refresh that happens from external world to us could be on demand, or could be through a scheduler. It could be incremental or a full refresh. And the biggest differentiating factor in this connect layer is our use of the NoSQL technology, which is a totally new and simplified way of pulling in raw data in any format and consuming only what is required, rather than relying on the source system to make all the changes, as it happened with traditional integrations in the past. So it's a radically different way, and what we've seen is typically integration takes at least 40% to 60%, depending on the size of the organization. The implementation time, 40 to 60% could go off in integration, and we are proposing to reduce that from months to just weeks. Right? So the connect layer, to summarize, connects from data from all over the landscape as part of an organization. Next slide, please. Enrich, it enables super users or analysts or maybe system integrators as part of the implementation to enrich the raw data that we pull in through the connect layer and add maybe user-defined fields, business validations and exceptions, missing data, formatting existing data. There could be date formats, number formats. The larger the size of the company, you find there's more and more disparate data, more and more systems as part of the landscape. Right? So some of the examples we've recently come across is a trading company. The business users want to dynamically add their own strategies for analysis, or for a manufacturing company, reclassification of their items and categories is very tough to manage, to go back to this traditional transaction system and change, and they wanted to dynamically change it in the front with, say, user-defined fields or some business rules. All examples now where we're saying using the self-service paradigm with the enrich layer. So now we enable the super user, analyst, or SI to take more control. Next slide, please. Analyze a suite of our algorithms solving high-value business issues with the right blend of modern technology, data scientists, and our knowledge of the commodities market. So we support the journey for, not just complex algorithms, but it could be simple analysis to medium-sized algorithms to even complicated algorithms using machine learning and artificial intelligence. Some of the examples of our algorithms include position, P&L explained, VAR, freight exposure, cash flow forecast, procurement analytics, and very recently predicting, the impact due to the likelihood of an event occurring in the market or in the environment. Next slide, please. The decide layer, which is our fourth layer, is to enable risk management and analysis with various graphical, visuals, reports, limit breaches, alerts, and notification. So it's not just a static way of looking at the data. It enables a platform for collaboration which is more interactive, dynamic, delivering high-value insights and more strategic analysis by stitching together all the data that you have in your landscape, some of which could be coming from internal sources, some of which could be coming from external sources, and some of which I'm sure will live in spreadsheets for, till God knows how much longer. Next slide, please. Eka Analytics works for every role. It could work for a trader who wants to know what events are causing changes to P&L. It could work for global risk managers who wants to know, use it as a trade surveillance tool. Production planners to improve the capacity utilization. Could work for logistic managers who want to improve, reduce their costs. Operation managers who want to understand the bottleneck and reduce or increase the throughput of the machines. The CEO, the CFO, who all want to look at one dashboard, an intelligence dashboard that gives them the pulse of what is happening. The procurement managers who want to know when to buy, what to buy, and whom to buy from in the market, depending on what signals they're getting. And more uniquely, it also works for analysts who can now define business rules and scale the business users without having to depend on the vendors. And it also works for the IT team now who have now a scalable platform which can enable business and make business more self-sufficient and grow them at a pace much faster than before. Next slide, please. So this works for Eka Analytics, works for every asset class. As mentioned before, we are commodity agnostic. So it works for agriculture, metals, crude and refined products, gas, foreign exchange, interest rate, petrochemicals, biofuels, and freight. You'll see, in fact, as one of the case studies or one of the use cases, we've taken an example of a refined products, but that is just an example and not indicative of, the only product that we handle. So we are truly commodity agnostic. Next slide, please. So let's dig deeper into, so all that we've been seeing so far is now, I'm going to take you through 2-3 slides to show a use case of how this whole problem, the current situation that exists in an organization and how, you can actually solve it, a use case, that you can see with a live example. So the segment that we are targeting, like I said, is just an example. It's refined products. The business is buying from refineries and selling to other companies. And the role that I'm playing as part of this use case is a global risk manager. As I mentioned, this it could truly work for many roles in the organization, but it could be the CFO or everybody looks at a dashboard differently, right? So this one is most suited for the global risk manager. So let's take the current situation. It's an example situation. So I can have 2 ETRM systems, one which I inherited because of, let's say, an acquisition. And of course, I'll have some data in my spreadsheets, some complicated pricing types or complicated trades where the current systems are not able to handle, and it's probably being managed in a spreadsheet today, right? So 3 systems already to manage my entire position. So as a global risk manager, what I need to see is my consolidated positions across my entire portfolio, right, from all these systems. The second thing is, I'll have a lot of data coming from, the data partners that, that I've subscribed to. So you can see here, refinery margins could be an example. Refinery utilization is an example. This is a refined use case example. So we've stuck to all the refined data, but there could be lot more, right? And then, the fourth example, which is the refinery outage trend data, so the historical outage trend data, right? So far, they're all sitting separately. And what the global risk manager wants to do is want to stitch all this together to see how do I see a consolidated view of my positions and how can I actually see the risks that the external impacts are causing on my portfolio and how can I take a corrective action in near real time? Next slide, please. So level 2, once I have so much data and the system Eka Analytics helps me stitch it all together, what can I see? So the dashboard on top, what it shows me is using the connect and the enrich layer, we've put together all the data, and now I can see a consolidated, as a global risk manager, I can see my consolidated positions. And once I'm able to see all of that together, I can see huge open positions in Houston on the dashboard 1, which is a consolidated positions from my ETRM 1, ETRM 2, and maybe my spreadsheets, right? Second analysis graph is even more interesting. What I've done as a global risk manager is using the Enrich layer, right? I have taken the number of outage occurrences that have happened in the last 2 years, which I've gotten from Reuters here, and I've actually classified it the way I think it needs to be categorized into stable, moderately stable, and unstable. So the rule that I have written is saying that, in the last 2 years, if a refinery has had number of occurrences more than 15 or 16 or 30, I want to classify it as unstable, and then I can have my own criteria to classify it as moderately stable and stable. But having done that classification, using the Enrich layer, I have been able to overlay my positions on top of this classification. And now clearly the graph there on the blue color and the donut shows you that 36.4% of my positions are at Houston, and Houston has been classified as unstable because of the way the number of occurrences of outages that have occurred in Houston. Right? So immediately what it does, it highlights the risk for a global risk manager with all that data, and I can see that that's my focus area. Next slide, please. So now what I want to do is I also want to, get into more details and analyze Houston further. So I've broken that down by positions, by months and gallons. So I can see now over a period of time, huge number of forward positions. I can see maximum, the two refined products are kerosene and gas oil. I can see that, gas oil is my area of concern as soon as I drill down further. Chart on the left, gas oil prices. What it is showing me is, so that's my gas oil open positions, my area of focus now, and this is how the market's moving for gas oil prices, and you can see that it is trending upwards. And it's not just prices, so we've taken the fair value prices from Thomson Reuters, and you can see now the trend is all upwards. To that, as a global risk manager, I've shocked and I've done a curve shift and seen what would be my worst case scenario and what would happen if I, estimate that the prices are going to be moving up by 5%, 7%, 10%, whatever my scenario could be. So I see my positions, I see how the market's trending upwards, and I have my own curve where I think where the markets could go. Right? Now the last chart on this page, what, to see the impact, what is the financial impact for me, taken the fair value prices, put it, overlaid it with my positions. So we've got a P&L, right, at Houston. So you can see what the positions are, buy, sells, consists of both, right? But the scenario that I'm trying to run right now is because Houston showed a huge number of outage occurrences in the past. So I've done two things with the scenario. One, I've saying what happens if the markets move up. We've also simulated a scenario which says what will happen if there is a 30% more chance of outages occurring in the next couple of months. And immediately the graph there shows me that, my P&L is reducing by 7 to 8%, 10% because of the occurrence of these two events, right? So right from the top, if we see, we had disparate data sitting in multiple systems. We had all the data in the landscape already. But what an analytic system can help to do is to stitch it together meaningfully and present to you an actionable insight which can help you take decisions faster, better, and identify opportunities and risk far sooner than what you were able to do before. Next slide, please. To conclude, what Eka can uniquely offer is to enable the modern enterprise data management and digitize the entire commodity value chain. One, by connecting internal and external sources to create a commodity data lake. And second is the speed to benefit by lowering the risk as well as rapid deployment and not having to wait for months before implementing the system and seeing the results. We're the only solution provider that can digitize a commodity value chain because of our deep knowledge of the energy, agriculture, metals, and bulk industry, and because we have some industry-specific advanced analysis which help to make better and faster decisions. They're all available. Many are available out of the box. And lastly, how we do it is with our experienced and local team of data partners, data scientists, IT professionals, and industry experts. Thank you for listening in today. Handing it over back to Rana.
Thank you very much, Preeti. We do have a couple questions. So as I ask those questions, I'm going to pop up one last poll for us. I'm going to come right up there. Lee mentioned Thomson Reuters has over 150 analysts covering commodities markets. Can you tell us more about what they cover and how to access their insights, please?
Yes, Rana, sure. We assembled this group over a number of years as a result of acquisitions and organic growth. They come from companies like Point Carbon in Norway that covered power, gas, and carbon markets, and from Landworth in Chicago that covered the supply side on agricultural, on grains and oilseeds. Also from a company called GFMS that we acquired in London, who are world-renowned leaders on forecasting fundamentals around precious metals and now base metals as well, and then organic growth that we've made in our oil analyst team. So together, the group of analysts, they all work together. There's lots of synergies in terms of things like shipping movements and weather-driven analysis, and they all work in one big group. And they are, all of their output can be seen quite easily on our core products. If you subscribe to an icon for commodities, you get access to all of their models and forecasts, which they are basing on the same sort of fundamental analysis that our customers do. We're not looking to replace the analysis that our customers do. We're simply trying to provide a view that they can reflect on. In some smaller companies, they do actually use some of the insights that we publish in order to figure out which way the markets are moving and inform their trading strategies. So as well as reading the analysis that our analysts produce, you can also look at their models and in terms of the forecasts that are made. And every single one of our analysts is also contactable over our messaging network. So you can engage them in discussions around why they've made certain assumptions and how their models work.
Fantastic. Thank you so much. And I'm going to go ahead and close the poll as I ask Preeti's question. My current solution vendors, such as E&C TRM and ERP, say they have all the reports and analysis I need. Why would I need your solution?
Sure, Anna. So, what we've seen in the market, and, we ourselves have ETRM, CTRM solutions and the analytics offering. So, first problem, in the real world scenario, right, all the data does not sit in one system. We have spoken to so many of our own customers, so many prospects, so many people in the market. The data doesn't truly sit in one system, right? So that's problem number one. Problem number two is even if we're sitting in a transaction system, so let's say there is a way that data gets consolidated, right? To run these kind of powerful analytics, the transaction systems were never suited to run analysis. They are more for data storage, data capture, and, more like a system of records. So the kind of speed and the kind of volume handling and the kind of processing power that is required, or the kind of data structures that are required to run high-speed analytics on transaction data is something that the earlier systems were not designed to. So you need some sort of, shift to a modern technology and to have a system that is built to run analysis, right? So two problems. One, data doesn't sit in one system. Second, even if we were to consolidate in one system, the systems are not really suited to run analysis. Hope that answers.
Fantastic. Thank you so much. We are at over our hour now, so we're out of our time for today. However, I do know there are more unanswered questions, and we will go ahead and get back to all of you individually. Thank you again, Lee and Preeti, for your expertise, and to all of our attendees for joining us. If you would like to get in touch with Eko or Thomson Reuters, please do not hesitate to reach out to me. Again, I will be sending the recording and the presentation tomorrow, and Thomson Reuters will be following up with their full report next week. Enjoy the rest of your day. I hope you have a great one. Bye now.